Let's finish this discussion of recording accounting transactions with a comprehensive example using that Circle Films series that we went through earlier. So the following slides are going to show Circle Films transactions and demonstrate the recording of transactions in the journal, the posting of information to the general ledger, the preparation of a trial balance, and the preparation of financial statements. So remember transaction 1. Step 1, what accounts are affected? Circle Films is receiving cash, so cash is increasing. Circle Films is issuing stock, so common stock is increasing. Step 2, what are the debits and credits? Cash is an asset, so debit the cash account to increase it. And then common stock is an equity account, so credit the common stock account to increase it. And then steps 3 and 4 are shown in the slide where they're recording the journal entry followed by the posted ledger information. So let's do the same thing for transaction number 2. What accounts are affected? Circle Films is receiving a camera and some memory cards, so both equipment and supplies are increasing. Then they're paying with cash, so cash is decreasing. In step 2, on the debits and credits, equipment and supplies are assets, so debit the equipment and supplies accounts to increase them. Cash is also an asset, so credit the cash account to decrease it. And then the slide shows the journal entry and the posted ledger information again. Transaction number 3. Accounts affected, they're receiving cash, so cash is increasing. The increase in cash results from Circle Films providing its service, so Circle Films service revenue is increasing. Step 2, the debits and credits. Cash is an asset, so debit cash to increase it. Revenues increase equity, so credit the service revenue account to increase it. And then again, the slide shows the journal entry and the posted ledger information. Transaction number 4. Accounts that are affected, they're receiving cash, so cash is increasing, but they haven't performed the service yet, remember? So it's a new liability to the customer that's called unearned revenue, kind of like that unearned rent we saw a minute ago. Debits and credits, cash is an asset, so debit the cash account to increase it. Unearned revenue is a liability, so credit the unearned revenue account to increase it. And again, recorded journal entry and posted ledger information is on the slide. Transaction number 5. Accounts affected, Circle Films is paying cash, so cash is decreasing, and then the decrease in cash results from Circle Films advertising its service, so their advertising expense is also increasing. Debits and credits, cash is an asset, so we're going to credit cash to decrease it, and then expenses decrease equity because they're lowering income. So debit the advertising expense account to increase it. And again, the journal entry and the posted ledger information are on the slide. Transaction number 6. Accounts affected. Circle Films is performing a service for a customer, so that's increasing service revenue, but they haven't received payment yet, so that means their accounts receivable account is also going to increase. Debits and credits. Accounts receivable is an asset, so we're going to debit the accounts receivable account to increase it. Revenues increase equity, so we're going to credit the service revenue account to increase it. Again, journal entry and posted ledger information on the slide. Transaction number 7. Accounts affected. Circle Films is receiving a camera, so equipment is going to be increasing, and then this time they're not paying cash. Remember, they signed that note for payment, so notes payable is increasing. Debits and credits. Equipment is an asset, so that's going to be a debit in order to increase it, and then notes payable is a liability, so that will be a credit in order to increase it. Journal entry and posted ledger information is on the slide. Transaction number 8. Accounts affected. Well, this time they're receiving cash, so cash is increasing, but they're receiving it because a customer is paying their invoice. So that means accounts receivable is decreasing. So debits and credits, cash is an asset, so we're going to debit cash to increase it, and then accounts receivable is also an asset, so we're going to credit accounts receivable to decrease it. Recorded journal information and posted ledger information or journal entry and posted ledger information is on the slide. Transaction number 9, accounts affected. Circle Films is paying cash. Remember, they're paying their employees, so cash is decreasing, and that reduction in cash results from wages paid to employees, so wage expense is increasing. Debits and credits, cash is an asset, so credit the cash account to decrease it, and then expenses decrease equity, so debit the wage expense account to increase it. Again, the slide shows recorded journal information, recorded journal entry, and the posted ledger information. Last one, last transaction, but we're not finished with the example. Transaction number 10, accounts affected. Circle Films is now paying cash to pay that dividend to the owners, so cash is decreasing, and then the cash payment is a distribution of company's assets to the owners, so dividends are increasing. Debits and credits, cash is an asset, so we're going to credit cash to decrease it. Dividends decrease equity, so we're going to debit dividends to increase it. And then the slide shows the recorded journal entry followed by the posted ledger information. Now let's take a look at the trial balance. So this trial balance presents a summary of the balances in the ledger based on those transactions. Notice that the total debit balances equal the total credit balances in the trial balance. So we don't need to make any corrections. Once the trial balance is finished, the final product of the accounting system can be prepared, and that's the financial statements. The income statement must be prepared first, then we do the statement of retained earnings, and then the balance sheet. The statement of retained earnings takes the beginning balance in retained earnings, adds net income, and subtracts dividend to get the current balance in retained earnings. Now that we have that retained earnings balance, that gets carried over to the balance sheet, and that shows the company's assets, liabilities, and equity at any point in time.